The coronavirus status is improving, inflation is picking up, markets are getting bumpier, people are able and choosing to work longer, and investor behavior gaps are increasing. That and more today in the third quarter of 2021 Quarterly Context webinar. Welcome to the Quarterly Context webinar for the friends and clients of the advisory group. I'm Greg Patterson, CEO. For those of you not familiar with the advisory group, we are a wealth and life strategy firm focused on helping business owners and leaders with their financial goals in their personal and family realms, their fiduciary and employee support efforts, and their communities through their foundations and endowments. To help and assist the strategic goal work we do for clients, our Quarterly Context webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, investor behavior patterns, and other information to help personal wealth and institutional clients stay more relaxed by staying more informed and then therefore making better decisions towards your goals. The first section is more high-level. Section 2, which some see as optional, has additional charts and details for those that are interested. We'll try to keep it to around 20 minutes or a little more than that. And we'll also circulate a video link should you like to view it again or pass it on to someone that you think might benefit like we've helped you. If you have any questions, please add it to the question box and we'll either answer as we go along or at the end. We always like to start with a reminder that the key thing, as always, is to focus on the intersection of the things that matter and the things that you can control, both in terms of long-term and short-term goals and what you can affect related to those things. And we are here to help you with that planning. Markets have been continuing to show some volatility in recent months, has picked up a little bit relative to the last number of years. And as always, there are news events along the way that contribute to that volatility. And in the very long run, as you can see in this upper chart here, short-term news has very little long-term impact, but it can make investors nervous in the short run. There are a number of elements in this slide. We won't go into too much detail, but a couple of quick points. The vaccine adoption has increased, but is still relatively slow. And when that happens, that allows new variants to happen more rapidly than if there were herd immunity. Fed rates remain low. The Fed is now broadcasting that they're likely to begin the bond purchase taper, but it hasn't come with the same taper tantrum that happened after the global financial crisis. There's some funky dynamics regarding unemployment. A lot of people are seeking even more openings and essentially leading to a shortage, which is one of the factors affecting inflation and markets. Consumer spending is solid. However, consumer confidence is starting to wane given a number of dynamics. The Delta variant is having an impact on the reopening and therefore the economies and GDP, and that's cooling things down again a little bit and affecting markets. China is slowing down again, also due to a surge in the Delta variant with growth rates in GDP, their GDP coming down quite a bit, and that's affecting emerging markets and some global markets as well. Inflation remains at elevated levels relative to the long term and recent periods, especially hovering a little bit above 5%, and driven in part due to supply chain challenges with ships and goods parked offshore because ports and drivers and trucks are less available and unable to distribute those products throughout the economy. As a result of all of this, or a number of these things, the stock market's been wobbling, negative to slightly flat for the quarter, depending on the region. And in terms of short-term dynamics, growth stocks beat value stocks for the quarter, but not for the year, whereas large is beating small for the quarter and the year, a bit of a reversal relative to a few quarters of bounce back for small and value. And bond yields remain unchanged, although it was pretty bumpy during the quarter, and lower quality bonds had an edge over the higher quality bonds in that short run. And the dollar's shown some recent strength, up about 2% versus a global basket of securities. And this is part of what the primary driver, the difference between international and US stocks. Coronavirus patterns after a period of an increase, not inconsistent with typical summer patterns, and also due to increasing, although gradual and not full adoption of the vaccine has dropped off. You can see here that globally numbers, the heat map shows better COVID status in the summer hemisphere as we approach summer in the southern hemisphere. And in the US, we are just a month away really from the flu season, and we'll see if that has any impact this year. Did not have a major impact last year, partly because so many people stayed home, hygiene was high, and if that's relaxed a little bit, we could see a little bit more flu activity relative to last year. In terms of some of the economic metrics, unemployment has improved quite a bit after the COVID spike. However, has been hovering around 5 to 5.5%. Wage growth has picked up a little bit, and that might ease some of the labor market concerns if that persists. Inflation has again picked up above what has been lower than historic levels, and those short-term dynamics mentioned earlier may be the biggest contributors. The Fed believes that those effects are temporary and that in 2022, inflation should be back closer to 2.2%. Consumer sentiment had been on an uptick, but has recently had a cool down there, as mentioned. And some of the notable elements regarding interest rates at the Fed level continue to be the same. Basically near zero, picked up before the COVID hiccup, and then dropped off again when COVID happened, and now hovering again near zero. This is additional stimulus plus the bond programs, and this is part of what's contributing to relatively elevated and some would say somewhat stretched stock valuations. The Fed wants to be careful about raising rates and tapering while also creating some dry powder for the next downturn. As a result of all these dynamics, as mentioned, markets are flat, essentially slightly negative in the US, only still relatively slightly negative in international emerging markets, much bumpier, primarily because of the China slowing growth. And China represents about half of the emerging markets marketplace in terms of market capitalization. Real estate also relatively flat, bonds relatively flat. So it's been a while since we've had a flat quarter, one direction or the other. And so in case you forgot, this is what it looks like. But the one-year numbers are still very strong given elevated returns due to a number of dynamics, and particularly due to stimulation and the some COVID recovery. In terms of the four worst downturn markets and their recoveries, we can see the global financial crisis plus COVID markets are ahead of the game relative to the other four worst US markets. Some cooling recently, interesting now, mimicking somewhat the shape of the 70s oil and embargo crisis post period. And it would be normal if this cooled off a bit to approach over time something that would be more like this projected return reverting a little bit to the mean. So don't be surprised if there's some cooling. Even if this were to have a 10 or 20% drop at some point, we would still be ahead of the game relative to long-term historical returns. So be careful about the high watermark mentality and be disciplined and focused on the long term. Here we can see updated numbers, still amazingly strong stock market returns, 10-year annualized returns. The worst was low 13s, whereas the long-term historical average is 10, with large cap growth being 20% return for the last 10 years. And that is very high, not sustainable. Since the market low, it's amazing to see what that recovery has been, up 130%. So a good reminder that when there is a big hiccup, sticking with it and catching that full recovery is really valuable and is really what helps build and recover long-term returns. Those that pared back out of concern and missed some of this are really actually just locking in returns rather than creating safety. Yield curves. Two different views of similar information, just different date ranges or date plots here. So if we look at this chart, this gray, darker gray band is the 10-year range. You can see the most recent line here in the middle has gone up a little bit relative to the mid-2020 yield curve, but still materially below numbers from about 10 years ago. Some interesting data recently. A study shows that people are able to work longer than they used to. And in our experience in interacting with clients, many clients are choosing to act longer for a sense of accomplishment, a sense of connection, and a sense of feeling productive and engaged. And so one question that we're posing to those personal wealth clients of ours and others is, if you were to do that, if you were to work longer, that by choice and by interest, that takes some pressure off the need to earn as much in the present day if you're pre-retirement phase, in which case, would that cause you to spend your time differently? Would that cause you to take the foot off the gas pedal a little bit and live a little more richly now with less pressure around earning now? So something to consider, something to think about to maximize your overall life experience. On the other end of the spectrum, in terms of the average investor, based on numbers from the average mutual fund investor out there, the behavior gap is increasing. The behavior gap is the difference between actual investment returns, in this case, looking just at stock market mutual fund returns relative to the S&P 500, and the average investor in 2020 underperformed because of behavior, not, in other words, typically by paring back on stocks when there's a concern or some sort of emotional investing, created an opportunity cost of 1% in 2020, 2% in just the first half of 2021, a whopping 4% over 10 years. And there have been 20-year periods where it was similar to this negative 4%, but that negative 4% is not too far off the inflation-adjusted stock market projection. So for some people, they're approaching a flat return in terms of growth adjusted for inflation just because they might not be as disciplined as they should be. So good guidance and sticking with it is critical. Having a plan makes it easier to stick with it. Whereas if you don't have a plan and you don't have a goal and that's not clear, people in general are more likely to react because they don't have that map to follow or the guidance and the behavioral coaching to go along with that. For those of you that are fiduciaries or have teen or adult children, there's an opportunity to help others. A recent study shows that the average investor and saver wants help. The study shows that 44% of people want help calculating their retirement savings goal. Most people really don't know how much they need to save and therefore may undersave. And about the same percent, around 40, wants help knowing how to invest. Most people don't have that expertise, don't have that guidance. And so again, if your children or your employees are anything like this, which if they're like most people do struggle with this to some degree, providing them some insight or guidance can help. This is the reason that the advisory group has been building a tool called Wealth Step, which is designed to help people. There will be a free public version and an advanced version for it's included for 401k plan clients that elect to use that. And is our way to try and have to help participants and have a a social financial literacy give back to do our part to help solve that broader problem and increase economic equity around the country, and who knows, maybe even around the world. 401k studies show, this may be representative of greater confidence in the economy, that companies that had, or in 2020, many suspended their match, and more recently have planned to or have reinstated that match. So those are the top ranked elements in that study, in this segment of it. Another part of the study shows that the use of target date funds has been shifting over time from 2010 to now. One of the most notable differences is the advent and increased use of custom target date funds, something the advisory group has been doing for a number of years and was actually an innovator in terms of the mid-market space. There's also the growth in collective investment trust target date funds. However, those have mostly borrowed from sometimes their equivalent fund on the mutual fund side, because collective investment trust minimums have come down. So that's sort of a one-for-one trade, whereas the custom target date strategies have been more of an upgrade in terms of minimizing fiduciary liability, expanding diversification, oftentimes reducing cost. Haven't shown this periodic table in a while. A lot of people get a kick out of seeing the crazy combination of colors here. For those that haven't seen this before, each column represents a year from 2002 through part of 2021, and at the top shows the highest return, the bottom shows the worst return, and each color is a different asset class. So the key message here, as you can see, is there is no predictable pattern to what will happen next. And as a result, it is a strong case visually and functionally for diversification by building a portfolio that ensures that you always have the top performing asset classes, and also ensures that you never have too much of the worst performing asset classes. The only overall patterns that tend to play out is that stocks tend to be in the upper range in the long run because of higher expected returns, and bonds tend to be in the lower part because of lower expected returns in the nature of bond markets. But in the short run, there can be bonds at the top and stocks at the bottom. The Nobel Prize in Economics was awarded a while back for basically that same conclusion of mixing things together can reduce your risk. With volatility picking up a little bit and the potential for more significant volatility sometime in the coming years, inevitable eventually, it can be helpful to see what year-by-year patterns have been over the last number of decades. And you can see here that the year returns are shown in gray. So not very many negative one-year returns, some significant ones along the way, like the global financial crisis. That's very uncommon, although not impossible in the future. However, what's really interesting is to see these red numbers, which is the worst intra-year number. So at some point during these gray years shown, that year experienced the drop shown in red, but the year ended up with the gray number. So what you can see is almost always, well, not almost, but always, there's a significantly higher full year return relative to the worst intraday return. And the reason we're showing you this is to help set expectations and remind you that if there is a bigger hiccup coming down the pike at some point, which is wouldn't be uncommon, it's more normal to have more volatility than we've experienced in the last 10 years. So when that does happen, that does drop 17, 18, 13, 8, 20. Most of those years end up positive. Sometimes they don't, but after those negative years, there's often a very strong following year. So remember that following a disciplined approach is key to keeping your long-term goals on track. In terms of the rules and regulations corner, no significant regulatory updates for personal wealth clients. For fiduciaries, the current DOL is reversing the previous administration's environment, social and governance, otherwise known as ESG or social screen type proxies or voting rules and or investing dynamics and what's allowed in terms of within retirement plans. The DOL has also updated guidance around the fiduciary rule and what advice providers have to adhere to in that process, and a few other updates here as well. Feel free to reach out to us or check out a couple of these links to explore more. A number of interesting blog posts might be up your alley, so take a peek at our blog. And if you find one that you like, share that with someone that you think might benefit from it. That is a great way to help people you care about. And as always, we are focused on providing the 5 requirements that help you if you're a personal wealth client, or your plan participants if you are a retirement plan fiduciary, or your stakeholders if you are a foundation endowment client, with the 5 resources that help fill the gaps where you might not want to be building an entire internal team or to do that for you. And we are always interested in feedback. Anytime you think there's something we can do better for you, please let us know. We thrive on helping, we thrive on improving, and we do try to incorporate ideas when we can. And as always, we are very thankful for those of you that have referred clients to us. Typical client sizes in different categories are shown right here. So that is the end of section 1. We won't be offended if you don't want to get into the details and if you hop off now, but for a quick review of a few additional data points, you can see here, this is what a typical business cycle looks like, and we're in, some would say, the expansion stage, depending, however, very much on the sector, because COVID has been an unusual dynamic where some were dramatically impacted negatively and some were dramatically impacted positively. Stock valuations, as mentioned before, remain relatively elevated, although the slightly negative returns cooled that off just a little bit, but above averages, in particular in large cap and growth sectors, less so in value and small cap, and still for the US, higher valuations relative to 25-year numbers as well compared to Europe, emerging markets, and other regions. And when elevations are relatively elevated, oftentimes that's followed by some periods of cooler returns. You can see volatility has been bumpier than the last 10 years, and more recently, not fully reflected here in this chart, but has picked up a little bit. Consumer, corporate, and US debt is mixed, has come way down for the average consumer. So the consumer is actually in very good shape relative to history. That's a good sign for the economy, potentially. And household net worth is up, partly given the stock market and real estate markets, which have been hitting some highs in the last quarters. Federal debt, however, is elevated and expected to go higher with stimulus programs that are in effect, possible infrastructure plans. And while that could stimulate the economy, it does create an increased burden that someone has to pay for eventually. Challenging and interesting dynamics there. No easy answer on that one. Quality numbers, qualities, stocks, higher quality stocks in terms of stronger balance sheets, better return on equity, and so forth, had a 1 in general for the quarter relative to weaker companies. For the year, it's a bit mixed, where value, where quality did more poorly and more speculative stocks did better in value. A bit of that bounce back after a period of being underappreciated, but still in growth, quality has played out and won out for the year. Overall, mutual fund flows show relatively strong inflows across the board. Looking back at 2020, this relates partly to that Dalbar emotional investor behavior gap study that quite a bit of money came out of stocks in the US and globally as the market continued to move forward. So people fell back and missed out on some of those returns by not being disciplined. And as a quick reminder, this is the process we go through, the 5 steps: analyze, design, formalize, implement, and monitor. Do this at the planning level, those 5 steps, and at the investment level more specifically here, both for personal wealth and institutional clients. And won't dwell on this here, but there are a number of personal wealth investor behavior studies, including the one we referenced earlier. This particular slide highlights how some institutional decision makers are not immune to that same dynamic, sometimes replacing investment managers within portfolios prematurely and leading to worse results. So having a disciplined approach is valuable for both personal wealth investors and institutional investors and clients as well. Thank you very much for your time. Glad to have you with us today, and we will take some questions now in a moment.